Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Arbutus Biopharma Corporation Annual Report. Arbutus Biopharma Corporation is a clinical-stage biopharmaceutical company that specializes in developing novel therapeutics for infectious diseases. The company's product pipeline includes two key products, imdusiran and a B-101. Imdusiran is an RNA therapeutic product candidate that has shown promising results in suppressing all HBV antigens, including HBsAg expression, in Phase 2A clinical trials. On the other hand, a B-101 is an oral PD-L1 inhibitor that has the potential to reawaken patients' HBV-specific immune response by inhibiting PD-L1. In addition to its product pipeline, Arbutus Biopharma Corporation also has a licensing agreement with Alnylam Pharmaceuticals, Inc., to develop and commercialize products using LNP delivery technology. This partnership allows the company to leverage cutting-edge technology in delivering therapeutics to patients. With its focus on infectious diseases and innovative technologies, Arbutus Biopharma Corporation is poised to make significant contributions to the field of biopharmaceuticals. The company's product pipeline and licensing agreements demonstrate its commitment to developing effective treatments for infectious diseases. By combining novel therapeutics with advanced delivery technologies, Arbutus Biopharma Corporation is well-positioned to address some of the most pressing health challenges facing society today. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be attributed to various factors. On one hand, collaborations and licenses have been a significant contributor to revenue growth, with an increase of $7,912 in 2025 compared to the previous year. This is evident from the substantial rise in revenue from these sources. On the other hand, certain factors have led to a decline in revenue. For instance, royalties from ONPATTRO sales decreased by $1,665 in 2025, indicating a drop in revenue from this source. Additionally, restructuring charges of $12.9 million were recognized in 2025, which further contributed to the decline in revenue. The sale of future royalties also had a significant impact on revenue growth. Although the company earned $26.5 million in royalties through December 31, 2025, the initial sale of future royalties for $20 million in 2019 suggests that this source of revenue may be limited. In conclusion, the primary drivers of revenue growth or decline for a company are influenced by various factors, including collaborations and licenses, royalties from ONPATTRO sales, restructuring charges, and the sale of future royalties. The net income of a company has been plagued by significant challenges, resulting in a substantial accumulated deficit of approximately $1.4 billion since its inception. The primary reason for this decline is the reduction in Medicare reimbursement levels, which has consistently led to negative net income figures. In fact, the company has reported no net income due to operating losses in nearly every year, with 2025 being the latest instance. The profit margins of the company have also suffered significantly, primarily due to increased rebates owed under the Medicare Part B and Part D inflation rebate scheme. This has led to a decrease in profit margins, making it increasingly difficult for the company to achieve profitability from its operations. Furthermore, the lack of revenue generated from product sales has rendered profit margins irrelevant, adding to the company's financial woes. As a result, there is a possibility that the company may never be profitable from its operations. The company's debt level and interest expenses have undergone significant changes over the years. Initially, the debt decreased by 47% from $34,341 to $18,042 between two specific periods. However, as of December 31, 2025, there was no outstanding debt. This indicates a substantial reduction in the company's debt obligations. In terms of interest expenses, there has been a notable decrease from -$69,000 to -$1,070,000. Additionally, non-cash interest expense decreased from $127 to $95. The amortization of interest related to future royalties is also accounted for as a discount with an estimated effective annual interest rate of 2.1%. These changes suggest that the company has made efforts to manage its debt and reduce its interest expenses. There is no mention of significant transactions involving the purchase or sale of assets or businesses in the recent financial report. The company's focus appears to be on its core operations and growth strategies, with no notable changes to its portfolio through acquisitions or divestitures. As a result, there are no new developments or implications arising from such transactions that need to be considered. Based on the information provided in the extracted summary, it is clear that the company has not engaged in any shareholder return activities. The company's policy of not paying cash dividends is explicitly stated on page 86 and further reinforced by the no answer to the question of share buyback on page 74. In essence, this means that the company has chosen to reinvest its profits rather than distributing them to shareholders through dividends or buying back shares. This decision may be driven by various factors, including a desire to maintain financial flexibility, invest in growth initiatives, or prioritize other business objectives. Whatever the reason, it is evident that the company's focus remains on internal growth and development rather than shareholder returns. That concludes the financial summary for Arbutus Biopharma Corporation. Feel free to comment below, and I will be happy to answer them when possible.